When we talk about the banking sector, especially in India, it's easy to feel a bit overwhelmed by all the numbers, right? Big, sometimes intimidating figures. But today, we're doing something a little different. We're not just looking at the numbers, we're digging into a story about a pretty remarkable transformation, some strategic shifts, and honestly, a few surprising twists in the Indian banking
Sure.
scene. Our focus for this deep dive. It's a 2025 financial performance of IDFC First Bank. We've got their latest annual report right here, and it's packed with insights, their strategy, the hurdles they've faced, and where they see themselves going.
Exactly. And our mission really is to pull out the most important bits, the real nuggets of insight from this report for you. We'll look at their financial health, obviously, but also how they're changing their business, their big strategic moves, and even, their wider impact. Think of it as, well, a shortcut to getting properly informed about this bank, which is becoming a really significant player.
Okay, but before we dive in, we need to put up a quick but really crucial note. The information we're sharing today, it's purely for your information, for your understanding. It is absolutely not financial or investment advice. Please don't take it that way. Investing in stocks, as you know, has risks. Always talk to a qualified financial advisor before making any investment decisions. Our goal here is simply to share the ideas and the data from the report itself, impartially. Arden, let's unpack this. IDFC First Bank's latest report for the year ending March 31st, 2025. It paints a really fascinating picture. You might expect, steady growth across the board for a bank that's transforming, but what we actually see is, well, a mix. Some impressive jumps, yes, but also a dip that catches the eye.
You've hit the nail on the head there. The big number that jumps out first is the profit after tax, the PA. It came in at 1,525 crore for FY25. Now that's a pretty significant drop, almost half, 48% down from 2,957 crore the previous year in FY24. It's definitely a headline figure. The report itself, though, is pretty clear about why. They point mainly to what they call headwinds in their microfinance business. We're talking about a few tricky factors hitting at once, things like climate issues affecting borrowers, maybe some overborrowing in certain areas, and apparently other lenders pulling back suddenly.
Okay, so challenges in microfinance. But what did the bank do about it?
Right, that's the key part. They were proactive. They didn't just sit back. They deliberately cut their exposure to microfinance. It went from about 6.6% of their loans down to 4.0%. And very importantly, they set aside a contingency provision of 315 crore, basically a safety buffer against potential future issues in that segment. A prudent move, really.
So that net profit number, while it looks a bit stark, maybe doesn't tell the whole story. Sounds like the core business might still be strong underneath.
Exactly. That's where you need to look deeper. If you look at their core operating profit, that's the profit from their main day-to-day banking before provisions and one-offs. It actually grew quite strongly. It was up 17.2% year on year, hitting 7,069 crore compared to 6,030 crore in FY24. So that tells you the core engine is, well, it's humming along nicely.
Okay, that's a much more positive sign. And what about the overall size of the bank?
Yeah.
Deposits, loans?
That side of the story is very strong. Total customer deposits reached 2.43 trillion. That's 2 million or 43,000 crore, up a solid 20.4% year on year. And get this, since the merger back in December 2018, their customer deposits have grown 6.3 times. That's huge. Their loan book, or total funded assets, also grew 20% year on year to 2,041,926 crore. That's 2.3 times bigger since the merger.
Wow, 6.3 times growth in deposits. That's quite something.
It really is. And it shows that strategic shift we talked about.
Yeah.
They've improved their credit to deposit ratio, the CD ratio, significantly. It was 137% back at the merger, meaning they were lending out much more than they had in deposits. Now it's down to a much healthier 93.9%. Plus, their Interlisa ratio, those cheaper current and savings account deposits, improved to 46.9%. All this helped bring their cost of funds down by 1.32 percentage points. Makes their funding cheaper. Boosts margins.
Yeah, that move away from wholesale funding towards retail deposits. I mean, that's just fundamental in banking, isn't it? It suggests they're building a much more stable foundation. It feels like they're following the path that many successful private banks took, building that solid base. It really indicates a clear strategy, putting them more in line with established peers. Now, this is where I think it gets really interesting. We see the numbers show resilience, but how do they actually rebuild the bank to get here? How did IDFC first go from being mostly an infrastructure lender to, well, a proper universal bank?
Oh, the transformation has been genuinely profound. They've completely reshaped their loan book. It used to be mostly wholesale credit, big corporate loans. Now they call it a well-diversified portfolio. Retail lending is now the biggest chunk, 65% of the total loan book, and it's spread across, I think the report says, more than 25 different business lines.
25. Like what specifically?
Yeah, so you've got things like home loans making up about 11%, loan against property around 12%, MSME financing is significant at 15%, rural finance at 4%, even things like salaried personal loans at 5%, and credit cards at 3%. And those large corporate loans, the ones that used to be their main focus, now just 1% of the book. It's a massive shift. It's really about spreading the risk, not having all their eggs in one basket.
That makes sense. A huge strategic pivot away from those concentrated infra risks.
But, okay, the big question then is how good are these new loans, this rapid growth in retail, rural, MSME, is the quality holding up? That's always the question with rapid growth, isn't it? But the numbers here look pretty solid. For the retail, rural, and MSME parts specifically, the gross NPA non-performing assets is at 1.70%, and the net NPA, after provisions, is down at 0.62%. That's quite tight. For the whole bank overall, gross NPA is 1.87% and net NPA is 0.53%. And their provision coverage ratio, the buffer against bad loans, has improved to a healthy 72.3%.
So they seem quite disciplined.
Very much so. They even talk about an internal target, this 2-1-2 formula for gross NPA, net NPA, and provisions. It suggests they're aiming for really tight control and strong buffers. Speaks to disciplined underwriting, even with the diversification.
Okay, good asset quality. What about their capital strength? The bank's own financial cushion.
Their capital adequacy ratio, CAR, was at 15.48%, which is healthy. But the big news here is the recent capital raise, that 7,500 core infusion from big names like Warburg Pincus and ADI Private Equity. That's set to boost their CRR significantly, up to around 18.2%. That's a very strong number. It also pushes their net worth up substantially to over 45,000 crore.
Right, I saw the CEO compared this to capital raises ICICI Bank did years ago.
Exactly. He made that point, saying these kinds of big capital injections are crucial for building, institutions for the long haul and for hitting ambitious targets like their goal of a 15% return on equity, or ROE. For anyone watching this bank, that capital raise is a massive signal of confidence and gives them serious firepower for future growth without straining themselves. It really underlines their ambition.
Okay, so we've covered the financials, the strategic shift in loans, the asset quality of the capital.
Yeah.
It feels like the core banking engine is being rebuilt quite effectively. But what about the other stuff, the things that really make a bank feel modern? Digital, financial inclusion, ESG. How are they doing there? These often show the real long-term thinking, don't they?
Absolutely. And they seem to be hitting these areas hard. On the digital innovation front, they talk about a cutting-edge technology stack, using AI and machine learning quite a bit. Their mobile app gets really high ratings, like 4.9 on Google Play, 4.8 on the App Store, apparently used by over 20 million customers. That tells you something about the user experience.
Those are top-tier app ratings.
They are. They've got digital onboarding, developer-friendly API portals for partnerships, and they even worked with NPCI to simplify IMPS money transfers, just making things smoother digitally. They've also been launching new products constantly. For corporates, things like cash management, trade finance. For retail customers, they launched the Ashva credit card. The interesting thing there is a very low 1% Forex markup and 10x rewards, which is quite competitive. Plus, things like specific Kizan credit cards and rural home loans for their growing rural base.
And that rural focus, the financial inclusion aspect.
Right.
How deep does that go?
It seems pretty deep. They mention having a strong presence in rural areas. They have an app called My First Bharat in 12 different regional languages, and they offer doorstep banking services. The impact numbers are quite striking. Over 6.9 lakh loans to microenterprises, 2.5 million loans to joint liability groups, supporting around 3 million households in total. It's not just lip service. It looks like real reach into underserved areas.
Okay, and ESG. Everyone talks about ESG now. Is it integrated?
It seems to be. They mentioned integrating ESG into their core business. A neat example is their green deposits. The money raised goes specifically to finance electric vehicles, and they've already financed 2.3 lakh electric two-wheelers, over 6,400 electric three-wheelers. They're also part of the UN Global Compact, PCF, for carbon accounting, and they say their ESG ratings are improving. And on governance, they highlight high standards, 80% independent directors on the board, 2 women directors, ISO certified for security, and interestingly, they make a point of mentioning 0 political contributions.
0 political contributions. That's quite a statement.
It is. It underlines that commitment to transparency and maybe staying above the fray.
Okay, so it sounds like they're genuinely trying to build more than just a profitable bank. This always you first idea and the social impact. How does that actually feel for customers? And what about their community work?
Well, the always you first idea seems tied to transparency and ethical practices. The report actually includes customer testimonials, which is interesting. People praising things like the credit card rewards, how fast loan processes are, how helpful the education loan team was. Specific examples like someone named Jayesh Panchal loving the reward points, others mentioning the speed and ease. Real feedback.
That's more convincing than just slogans.
Right. And their brand building is also a bit different. They launched India's first branded podcast by a bank called A Century of Stories India. They also have a cricket podcast linked to their BCCI sponsorship, and another one called First Stock for private banking clients with industry leaders. It's about engaging content, not just ads.
Interesting approach. And the direct community work, the CSR.
It looks pretty extensive for FY25. They say they reached over 98.5 lakh people through 57 different programs. And employee involvement seems high. Over 16,000 staff volunteered nearly 24,000 hours. Key programs include an MBA scholarship for bright students from low-income backgrounds, chosen transparently based on merit and need. The CEO apparently even meets them. There's also Fuetra, a dairy development program helping farmers, especially women, improve their income through better practices. The report gives an example of a farmer boosting milk yield and earning an extra euro 16,000 a year. Real impact.
Tangible.
Exactly. They also support centers for kids with disabilities, run employee volunteering for financial literacy, reaching over 48,000 people. And just recently, on January 1st, 2025, they launched the IDFC First Academy, a dedicated financial literacy platform aiming to simplify finance for everyone, available online and via their app.
Well, we've certainly covered a lot of ground here on IDFC First Bank's FY25. We've seen them handle that dip in PIA driven by specific microfinance issues, but also show really robust growth in deposits and loans. And underpinning it all seems to be this deep commitment to digital, to inclusion, strong governance. It really does feel like they're forging their own path, doesn't it? Quite distinct with that retail focus and the social initiatives woven in.
And indeed. This deep dive really shows a bank in the midst of a significant transformation, right, within India's incredibly dynamic financial world. And it makes you think, doesn't it? As India keeps evolving so quickly, economically and digitally, how much will a bank's success depend not just on short-term financial strength, but on really embedding that long-term view, that commitment to social good, to deep financial inclusion? Could that be what truly defines a world-class bank in India in the coming years? Something to ponder.